For investors who are on the hunt for income-paying stocks, one of the first types of investments that they usually come across are mortgage REITs. These stocks always come with significantly higher yields than what you typically find from consumer staples, utilities, and regular equity REITs. Companies like AGNC, Dynex Capital, and New York Mortgage Trust usually offer yields anywhere from 8% on the low end to over 15% on the high end. What's more is that a good amount of these companies do pay monthly dividends, only adding to their appeal. But what's unfortunate is that out of all the high-yielding types of investments that exist, mortgage REITs are almost always the worst in terms of performance. According to the National Association of Real Estate Investment Trusts, the average total return over the past 20 years in the entire mREIT sector was only 1.9%. That's not just in terms of share price, but also factoring in those huge dividends. This far underperforms other asset classes that provide high yields, and in my opinion, a lot of these mREITs discourage investors from pursuing higher yielding investments altogether. I get a lot of questions about these companies, and a lot of people are often wondering why on earth are the vast majority of these companies so bad? Because based on how these businesses describe themselves, they often sound like really safe investments. But the reality is, most aren't and have pretty poor long-term track records. In this video, I'll go in depth on how mortgage REITs work and explain why most mortgage REITs are usually bad performers over time. When talking about mortgage REITs, every company and their investing styles are different, but I'd say there's two main types of mREITs that exist. The first type of mortgage REITs are the ones that focus on buying mortgage-related securities. These are investments that are created by financial institutions and which companies like NAREIT Capital and AGNC purchase. I'd say this is the most common strategy that exists for mortgage REITs, and practically all of the largest companies in this sector pursue this strategy. These are the types of mortgage-related securities that these companies usually purchase. The most popular investments are agency mortgage-backed securities, non-agency mortgage-backed securities, and mortgage servicing rights. There's other investments I've seen mREITs hold, such as collateralized loan obligations, collateralized mortgage obligations, and even consumer debt, among others. But these are almost always a very minuscule part of their portfolios, usually accounting for less than 5% on average, I'd say, so I won't discuss them in this video. Now, based on their titles, you'd likely have no idea what any of this stuff is if you've never done your research, so I'll give a brief description over the most popular investments. Ever since the 2008 financial crisis, agency MBSs have been the asset class of choice for mREITs, and the majority of the largest mREITs focus on these investments, so I'll spend the largest amount of time explaining these. Agency MBSs are pools of residential mortgages that are guaranteed by government-sponsored enterprises, or GSEs. The two GSEs that exist are Fannie Mae and Freddie Mac, and these agencies back all of the mortgages in these MBSs. Should any of these mortgages fail, then the agency will buy back the mortgage at its original value. Financial institutions will bundle thousands of these guaranteed mortgages and put them into securities, which mortgage REITs buy. These agency MBSs are given the highest quality rating since they're fully guaranteed and are sometimes compared to US Treasuries given how safe they are. Now, to a lesser extent, mREITs will also hold non-agency MBSs. These are practically the exact same as agency MBSs, only as you can probably imagine, these mortgages are not guaranteed by any government-sponsored enterprise. Although ever since the housing crisis, borrowing standards have been required to be much higher, and these non-agency securities are considered to be riskier, but they do come with higher yields. Most mREITs don't hold a lot of these securities, instead focusing on agency MBSs instead. Before the housing crisis, there actually were mortgage REITs that held a lot of these non-agency MBS investments, but a lot of them actually went bankrupt due to the high amount of mortgage defaults. A third type of investment held by many mortgage REITs are MSRs, which are mortgage servicing rights. These are agreements set up by a mortgage lender to basically have a third-party company come in and basically manage the mortgage on their behalf. This third-party company is responsible for collecting the payments from the borrower and performing other administrative services. So for example, a bank will issue out a mortgage to an individual and then give the MSR holder the responsibility of collecting payments and forwarding them on to the bank. And in exchange, the bank will pay the MSR holder a certain amount for servicing the mortgage. Most mREITs don't hold a lot of MSRs, but they can potentially make up a decent amount of their overall portfolio. There are some mREITs that do specialize pretty heavily in MSRs though. Now, after hearing agency MBSs explained, which again make up the overwhelming majority of an mREIT's holdings on average, you're likely asking some questions. If mREITs like NAREIT Capital invest the majority of their capital on these types of investments, how on earth could they have such poor returns? A diversified pool of guaranteed AAA investments sounds like a no-lose situation. Virtually all mortgage REITs love to advertise that their main strategy involves holding these ultra-safe investments, which persuades a lot of investors to hold their stock. I myself used to hold Dynex Capital in my portfolio many years ago after reading that they invest in these super safe investments. So what then explains these regular dividend cuts these stocks go through if they're holding these super safe investments? And this is the most important thing to know about how these companies make their profits. The vast majority of mREITs that exist earn their revenue from the net interest spread between the interest earned from their mortgage-related investments and their borrowing costs. In other words, mortgage REITs have to perform a balancing act in borrowing money and earning interest. I'll give a very basic hypothetical example of what this normally looks like. Let's say, for example, AGNC Investment Corporation wants to purchase agency MBSs from a bank. AGNC will need to borrow the money needed to make the purchase. They eventually find a lender who's willing to lend them money with an interest rate of 5%. This means that as long as the agency MBSs yield at least 5%, AGNC can make a profit. As long as the mREIT is earning more from their mortgage-related investments than what they're paying in interest, they'll make a profit. So that sounds pretty straightforward, right? Well, there's actually a problem with doing this. It's important to know that these agency MBSs do not naturally come with high yields. There are no investments out there that offer the kinds of yields mortgage REITs offer that are as safe as US Treasuries. Mortgage REITs have to employ additional investment strategies in order to inflate their yields to what's typical for them. This leads to the second way these companies earn revenue, which is their use of leverage. All of these mortgage REITs rely on leverage to offer investors these attractive higher yields. This means the company will use a significant amount of debt in an attempt to amplify their returns on these investments. Using leverage leads to better times when their investments are doing good and worse times when their investments are doing bad. As you can imagine, using a lot of leverage is always risky, and companies frequently adjust the amount of leverage they expose themselves to depending on how the real estate sector is doing. So this explains how these companies earn their income and provide these high yields to investors. In the last year, we've been seeing a lot of these companies having to slash their dividend distributions because right now is a particularly difficult situation for mortgage REITs. The reason for this is because of how high interest rates currently are. When the federal funds rate increases, borrowing costs increase. So these mREITs now have to pay more for the money they need to buy MBSs, so they'll need to earn more interest from their investments as well. This shrinks their net interest spread even more, and they've been earning less revenue, even reporting sizable losses while interest rates remain high. So when rates are high, most mREITs will earn less money, and non-agency MBSs and commercial mortgage-backed securities will have more defaults. But even when interest rates were at historic lows, mREITs still weren't performing great. Some do have periods where they have increased their dividends, but nearly all of these mREITs have gone downhill over time. If you recall at the beginning, I mentioned that there are other types of mREITs that exist. The second type of mortgage REITs that exist would be the companies that actually issue their own loans as opposed to investing in already established loan securities. Some examples of companies that do this include Blackstone Mortgage Trust, ticker BXMT, and Ares Commercial Real Estate, ACRE. These mREITs usually invest more in commercial real estate, so like offices, multifamily properties, and strip malls. On average, these mREITs usually perform much better than the first type we discussed, but they're still a high-risk asset. Defaults are the biggest risk for these kinds of companies. If you have more than just a couple in your portfolio, they can result in a dividend cut. Finally, one more type of mREIT that you don't really see anymore are called hybrid REITs. Although these have officially been classified as mortgage REITs for a while, these companies own a blend of physical properties and mortgages. The only one I can think of that actually owns a somewhat decent amount of properties in their portfolio would be Starwood Property Trust. These kinds of mREITs usually do much better over time than the ones that just hold MBSs. And another downside for the mREITs that hold MBSs or issue their own loans is the fact that they have to pay out 90% of their earnings to shareholders in the form of dividends. This doesn't leave too much room left over if they do suffer sizable losses for them to rebuild their portfolios. So in summary, the majority of mREITs that exist are typically mediocre investments because of their high leverage, a low net interest spread, and high interest rates. The only people who can actually profit from these stocks is when they actually time their buy just right, but I don't believe in trying to time the market as being a good strategy. But with that being said, that's going to conclude this video. If you know someone who's struggling to understand these investments, then feel free to share this video, which will hopefully provide them with the information they're looking for. But again, thanks so much for watching. If you're interested, feel free to check out my Patreon, where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel, where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.